Here is a question worth sitting with. The federal government created an account that lets your money grow completely tax-free, on dividends, on capital gains, on interest, and when you take it out, the Canada Revenue Agency gets nothing. Not a dollar. And yet the majority of Canadians who have access to this account either have it sitting in cash earning next to nothing, or they have never come close to filling it up. Today we are going to fix that. The name tax-free savings account is genuinely misleading, because most people hear the word savings and think of a basic deposit account at their bank. The TFSA is really a registered investment account that happens to carry a powerful tax shield. You can hold stocks, ETFs, bonds, GICs, mutual funds, and yes, plain cash inside it. The critical distinction is what happens to the growth inside that account. The government simply does not tax it, ever. Contribution room is where most Canadians get confused, so let us be precise. Room accumulates every calendar year for any Canadian resident who is 18 or older, and it carries forward indefinitely if you do not use it. If you have never contributed and you were 18 or older in 2009 when the TFSA launched, your total accumulated room as of 2025 is $82,000. That is a substantial tax shelter sitting available to most adult Canadians right now. For 2025, the annual TFSA contribution limit is $7,000. That is indexed to inflation in $500 increments, so over time that annual number will likely grow. If you have not contributed the full amount in prior years, every unused dollar rolls forward and becomes new room you can use today. The CRA tracks your contribution room, and you can check your exact available room through your My CRA account online. The real argument for maxing your TFSA is not the contribution limit, it is what happens inside the account over decades when compounding is not interrupted by annual tax drag. In a regular taxable account, every dividend check and every realized gain gets trimmed by the CRA each year. Inside a TFSA, that full amount stays invested and compounds on itself. Over a 30-year horizon, the difference between a taxed and an untaxed compounding account at the same return can be measured in hundreds of thousands of dollars for ordinary working Canadians. Because the TFSA shelters growth from tax, the strategic move is to hold your highest growth or highest income assets inside it. That typically means equities, broad market ETFs, dividend-paying Canadian stocks, or growth-oriented funds, rather than low-yield cash or GICs, which you can hold anywhere. Think of the TFSA as your most valuable shelf space. You would not store a bicycle on a shelf designed for your most prized possessions. Put the assets that generate the most taxable income and growth on that shelf. The honest answer is that it depends on your income, but for most Canadians under a middle income threshold the TFSA wins as the first priority. The RRSP gives you a tax deduction today but taxes you on withdrawal in retirement. The TFSA gives you no deduction today but zero tax on withdrawal ever. If your income in retirement is likely to be comparable to your income now, or if you want flexibility to access funds before retirement without penalty, the TFSA is typically the stronger starting point. One of the most misunderstood features of the TFSA is the withdrawal rule, and getting this wrong can cost you. If you withdraw money from your TFSA, that contribution room is not immediately restored. It comes back on January 1st of the following calendar year. Contributing the same amount back in the same calendar year you withdrew it counts as a new contribution against your room, and if you are already at your limit, that triggers an overcontribution penalty from the CRA of 1% per month on the excess. Mark that date, January 1st, if you plan to recontribute after a withdrawal. The Canadians who consistently max their TFSA are not necessarily earning more, they are automating the habit. Set up a pre-authorized transfer from your checking account on the same day as your pay deposit, even if it is a modest weekly or bi-weekly amount that totals $7,000 over the year. Do not wait until you have a lump sum. Automate it, invest it immediately into a low-cost index ETF, and let the compounding begin. The account you keep intending to fund someday is the account that will be worth the least when you need it most. 3 mistakes come up repeatedly. First, holding the TFSA entirely in cash. This wastes the tax-free growth advantage entirely. Second, overcontributing by not tracking your room carefully, which triggers that CRA penalty. Third, holding foreign dividend-paying stocks inside the TFSA without understanding that foreign withholding tax, for example on United States dividends, is not recoverable inside a TFSA the way it is inside an RRSP. These are not obscure edge cases. They are the most common ways Canadians quietly undermine their own accounts. The TFSA was introduced in 2009 as a deliberate policy tool to encourage Canadian household savings and reduce dependence on public retirement programs. It is one of the more generous tax shelters available to ordinary Canadians across all income levels, not just to the wealthy. In the context of elevated living costs, mortgage pressure, and a labor market still finding its footing, the TFSA is one of the few remaining levers that individual Canadians can pull entirely within their own control to build long-term financial resilience. Going forward, watch for the federal budget each spring, which is typically where any changes to annual TFSA limits or contribution rules are announced. Log into your CRA My account at least once per year to confirm your exact available room before contributing. Do not rely on memory or rough math. And if you are approaching retirement, watch for future videos on the TFSA versus RRSP withdrawal sequencing question, because the order in which you draw down those accounts can meaningfully affect your net income. If this kind of analysis helps you make better financial decisions, subscribing ensures you will not miss the next one.